You know what nobody's talking about? The fact that we're watching the silver mining industry collapse in real time. And when this thing finally breaks, the price explosion is going to make 2011 look like a warm-up act. I'm talking about a supply crisis so severe that it could send silver from $30 to triple digits faster than most people think possible. Let me show you what's really happening here, because the data coming out of the mining sector right now is absolutely shocking. We're not just seeing a slowdown. We're watching the systematic destruction of silver supply at the exact moment when demand is hitting levels we've never seen before in human history. Here's the thing that should terrify anyone paying attention. Primary silver mines, the ones that actually dig specifically for silver, they make up less than 30% of global supply. Think about that for a second. The majority of silver comes as a byproduct from copper, lead, and zinc mines. These companies aren't mining for silver. They're mining for base metals, and silver just happens to come along for the ride. Now here's where it gets interesting. Copper prices have been under pressure. Zinc operations are shutting down left and right. Lead mining is becoming economically unviable in multiple regions. And when these base metal operations slow down or close, guess what disappears with them? The silver supply that nobody was specifically mining for in the first place. I was looking at data from Peru last month, and this is where you start to see the real crisis forming. Peru is the world's second largest silver producer, pumping out roughly 110 million ounces a year. But their production dropped 8% year over year in the last quarter. That's not a small dip. That's nearly 9 million ounces just vanishing from global supply in a single quarter from one country. Mexico, the world's largest silver producer, they're facing their own nightmare. Environmental regulations are tightening. Community opposition to mining is intensifying. Energy costs are skyrocketing. And here's the kicker. Their production peaked back in 2015 at 189 million ounces. Last year, they barely hit 160 million. That's 29 million ounces of annual production that just disappeared. And it's not coming back. But let me tell you about something even more disturbing that's happening right now. The grade decline. This is the silent killer of the silver mining industry, and almost nobody outside the sector understands how devastating this is. Back in 2005, the average silver mine was pulling ore out of the ground with grades around 10 ounces per ton. Today, that number has collapsed to around 6 ounces per ton. You're having to move 67% more rock to get the same amount of silver. The energy costs alone are crushing these operations. I talked to a mining engineer a few weeks ago who works at a major operation in Nevada, and he told me something that should make every silver investor sit up and pay attention. He said their ore grades have declined so much in the past 5 years that they're now spending $23 to produce an ounce of silver that's selling for $30. At current prices, they're making $7 per ounce. But here's the problem. When you factor in sustaining capital expenditures, the real cost is closer to $26 per ounce. They're barely breaking even, and that's at one of the more efficient operations in North America. Now multiply that across the entire industry. You've got hundreds of silver mining operations worldwide that are either losing money or making margins so thin that one bad quarter could shut them down permanently. And that's exactly what's starting to happen. In the past 18 months, we've seen 14 significant silver mining operations either suspend production or announce closure plans. That's not normal. That's a crisis. And each one of those closures represents millions of ounces that will never hit the market. Here's where the story gets even more interesting. The exploration side of this equation has completely collapsed. Back in 2012, mining companies were spending over $2 billion annually on silver exploration. Last year, that number was barely $400 million. You're looking at an 80% decline in exploration spending. Why does that matter? Because it takes 10 to 15 years to bring a new silver mine from discovery to production. The lack of exploration spending today means there are no new major silver mines coming online in the 2030s. None. The pipeline is empty. Let me paint you a picture of what this means. Imagine you're running a business, and you know that in 10 years, your current suppliers are going to run out of inventory. But instead of finding new suppliers, you're actually spending 80% less on finding them. That's the silver mining industry right now. They're not replacing the reserves they're depleting, and the clock is ticking. Now let's talk about what's happening on the demand side, because this is where the crisis becomes a catastrophe. Industrial demand for silver hit 539 million ounces last year. That's up from 487 million ounces just 5 years ago. And it's accelerating. Solar panels alone are consuming over 140 million ounces annually now. Every single solar panel requires about 20 grams of silver, and global solar installations are projected to double by 2030. You're looking at potential demand of 280 million ounces just from solar in 6 years. That's more than the entire annual production of Mexico. Electric vehicles are another monster. Each EV uses roughly twice as much silver as a traditional car. We're talking about 25 to 50 grams per vehicle, depending on the model. Global EV sales hit 14 million units last year. If that grows to 40 million by 2030, which is the current projection, you're adding another 50 million ounces of annual silver demand just from the automotive sector. 5G infrastructure is consuming silver at rates nobody predicted. Every 5G base station requires significantly more silver than 4G. China alone is planning to install 2 million 5G base stations by 2025. Each one uses approximately 1 kilogram of silver. That's 64 million ounces right there from one country's telecom build-out. But here's what really keeps me up at night. Investment demand hasn't even kicked in yet. Last year, investment demand for physical silver was only 237 million ounces. That sounds like a lot until you realize that in 2015, investment demand hit 294 million ounces. We're actually below the levels we saw during the last silver bull market. What happens when investors wake up to this supply crisis? What happens when the general public realizes that silver is being consumed in technology faster than it's being mined, and there are no new mines coming online to replace depleting reserves? I'll tell you what happens. You get 2011 on steroids. Back in 2011, silver went from $18 to $49 in less than 4 months. That was a 172% gain in 120 days. And that was with much healthier supply fundamentals than we have today. The mining industry was actually growing back then. Exploration spending was robust, ore grades were higher, and industrial demand was a fraction of what it is now. Think about what a similar move would look like today. Silver at $30 going to $80 in 4 months. Except this time, the fundamentals are so much more extreme that $80 might just be the beginning. Let me tell you about something that happened in the palladium market that should serve as a warning for what's coming in silver. Back in 2018, palladium was trading around $1,000 per ounce. The market knew there was a supply deficit, but it was manageable. Then the deficit widened. Automotive demand kept growing. And suddenly, in less than 2 years, palladium exploded to $2,800 per ounce. It nearly tripled because the market finally woke up to the fact that there simply wasn't enough supply to meet demand. Silver is setting up for the exact same scenario, except the supply deficit in silver is actually worse. The World Silver Institute reported that the silver market ran a deficit of 142 million ounces last year. That deficit is projected to widen to over 200 million ounces this year. You're talking about consuming 20% more silver than the world is producing. Where's that extra silver coming from? Existing stockpiles. But here's the problem. Those stockpiles are finite, and they're depleting fast. COMEX silver inventories have dropped from 400 million ounces in 2021 to around 270 million ounces today. That's 130 million ounces that just vanished from the most visible silver stockpile in the world in less than 4 years. The London Bullion Market Association vaults are showing similar drawdowns. Silver held in London vaults has declined by over 100 million ounces since 2020. This metal is leaving the vaults and going into industrial applications where it's being consumed and destroyed. It's not coming back. Now here's where I need to take a quick detour, because if you're sitting on $100,000 or more in retirement accounts, this supply crisis is something you need to be thinking about seriously. I put together a free guide on how gold IRAs work, and it covers silver options too. It's in the description below. Shows you exactly how to get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if you're concerned about protecting your retirement savings from what's coming. But let me get back to this supply crisis, because there's more you need to understand. The Chinese are watching this situation very carefully, and their behavior is telling. China imported 6,200 tons of silver last year. That's 199 million ounces. They're the world's largest silver importer, and their imports have been accelerating. Why? Because they understand what's coming. They're stockpiling silver for their industrial needs, and they're doing it before the price explodes. India is doing the same thing. Indian silver imports hit 180 million ounces last year, up from 140 million the year before. These aren't investment flows. This is industrial and cultural demand from two countries with a combined population of 2.8 billion people. Let me tell you about a conversation I had with a silver refiner in Switzerland last month. This guy processes silver for some of the largest industrial consumers in Europe. He told me that his clients are now placing orders 6 to 8 months in advance, and they're willing to pay premiums above spot price to secure supply. That's not normal. That's panic buying disguised as forward planning. He said something that really stuck with me. He said, 5 years ago, my clients would order silver 30 days before they needed it. Today, they're ordering 8 months out and asking if I can guarantee delivery. They're terrified of not being able to get the silver they need to keep their production lines running. That's the real crisis. It's not just about the price of silver going up. It's about the possibility that at some point, there might not be enough silver available at any price to meet industrial demand. And when that realization hits the market, the price is going to do things that seem impossible right now. Let's talk about the paper silver market for a minute, because this is where things could get really explosive. The COMEX silver market trades roughly 150 times more silver in paper contracts than actually exists in physical form in their vaults. Think about that. For every ounce of real silver sitting in a COMEX vault, there are 150 paper claims on that silver. This works fine as long as everyone's playing the paper game. But what happens when industrial users start demanding physical delivery? What happens when investors lose faith in paper silver and start asking for the real metal? We got a preview of this in March 2020. Silver premiums exploded to $8 over spot. You couldn't buy physical silver anywhere. Dealers were sold out. Mints were shut down. And the paper price on COMEX was showing $14, while you couldn't buy a physical ounce for less than $22. The paper market completely disconnected from physical reality. That was a temporary disruption caused by COVID lockdowns. Imagine what happens when the disconnect is caused by a genuine, sustained supply deficit that's getting worse every quarter. The paper market could completely collapse, and the real price of physical silver could go to levels that seem absurd right now. I want to tell you about what happened in the nickel market in March 2022, because it's a perfect example of what can happen when paper markets meet physical reality. Nickel was trading around $25,000 per ton on the London Metal Exchange. Then, a massive short squeeze developed. In less than 24 hours, nickel exploded to $100,000 per ton. It quadrupled in one day. The LME had to halt trading and cancel trades because the price move was so extreme. That was nickel, a market that's much larger and more liquid than silver. If a short squeeze can do that to nickel, imagine what it could do to silver, where the paper market is even more leveraged and the physical supply situation is even tighter. Here's another angle that nobody's talking about. The energy crisis is making silver mining exponentially more expensive. Mining is one of the most energy-intensive industries on the planet. You're running massive trucks, operating crushers and mills, powering ventilation systems in underground mines. It takes enormous amounts of energy. Energy costs have roughly doubled in many mining jurisdictions over the past 3 years. That means the cost of producing silver has increased dramatically, even before you factor in the declining ore grades. Mines that were profitable at $20 silver with cheap energy are now barely breaking even at $30 silver with expensive energy. And it's not just energy. Labor costs are up. Equipment costs are up. Regulatory compliance costs are up. Environmental remediation costs are up. Every single input cost for silver mining has increased, and there's no sign of these costs coming back down. What does this mean? It means the floor price for silver is rising. The price below which mines start shutting down is probably somewhere around $24 to $26 now. And as more marginal operations close, that floor keeps rising because the remaining producers have even more pricing power. Let me tell you about a silver mine in Bolivia that just announced closure last month. This operation was producing 4 million ounces a year. They cited declining ore grades, rising costs, and insufficient profit margins at current silver prices. 4 million ounces just disappeared from global supply. And this is happening at multiple operations around the world. The really scary part is that once these mines close, they don't just restart when prices go higher. Mines are complex operations. When you shut down an underground mine, it floods. Equipment deteriorates. Skilled workers leave and find other jobs. Restarting a closed mine can take years and cost hundreds of millions of dollars. For many of these operations, closure is permanent. So we're in this situation where supply is declining, demand is accelerating, stockpiles are depleting, and the mining industry has no ability to respond quickly, even if prices double from here. The supply response that would normally moderate a price spike simply doesn't exist in silver right now. Let's talk about what the smart money is doing, because their behavior is extremely revealing. Central banks don't buy silver the way they buy gold, but sovereign wealth funds and large institutional investors are starting to accumulate physical silver in size. I'm seeing reports of large physical silver purchases by entities in the Middle East and Asia. We're talking about 10 million, 20 million ounce purchases. These aren't traders. These are long-term strategic buyers who understand that silver is being systematically undervalued relative to its supply-demand fundamentals. The gold-to-silver ratio is currently sitting around 88 to 1. That means it takes 88 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. During periods of silver strength, it's dropped as low as 30 to 1. If silver just reverts to the historical average ratio with gold at $2,650, you're looking at silver prices around $44. If it goes to 50 to 1, which is entirely possible given the supply situation, you're looking at $53 silver. But here's what I think people are missing. The historical ratio is based on a world where silver wasn't being consumed and destroyed in industrial applications at the rate it is today. The ratio might need to reset much lower to reflect the new reality of silver as a critical industrial metal that's in structural deficit. Think about it this way. Gold is primarily a monetary metal and a store of value. It gets mined, refined, and stored. Very little gold is actually consumed. Silver is different. Over 50% of silver demand is industrial, and that silver is being used up in applications where it can't be economically recovered. It's gone forever. So you're comparing a metal that's being hoarded and stored to a metal that's being consumed and destroyed. The pricing relationship between these two metals is going to have to change to reflect that fundamental difference. Let me tell you what I think is going to happen over the next 12 to 24 months. The supply deficit is going to continue widening. More mines are going to announce closures or production cuts. Industrial users are going to start competing more aggressively for available supply. And at some point, probably triggered by a supply disruption or a major industrial buyer securing long-term supply contracts, the market is going to wake up to the crisis. When that happens, you're going to see silver move in ways that shock people. I'm talking about $5 to $10 moves in a single day, premiums on physical silver exploding to $15 or $20 over spot, delivery delays extending to 6 months or more, and a complete breakdown in the relationship between paper silver prices and physical silver availability. The investors who position themselves before this crisis becomes obvious are going to make generational wealth. The ones who wait until it's on the front page of the Wall Street Journal are going to be paying triple-digit prices for silver and wondering how they missed it. Here's the thing that really gets me. All the data is public. The mining production numbers are available. The demand projections are published. The inventory drawdowns are reported. This isn't hidden information. It's just that nobody's connecting the dots and understanding what it means. We're watching the setup for one of the greatest supply squeezes in commodity market history, and it's happening in slow motion right in front of us. The silver mining industry is collapsing. Industrial demand is accelerating. Stockpiles are depleting, and the price is still under $35. This is the opportunity. Right now. Before the crisis becomes undeniable. Before silver breaks $50 and heads toward triple digits. Before physical premiums make it prohibitively expensive to acquire. This is the moment when positioning yourself in silver could be the single best financial decision you make this decade. The silver mining crisis isn't coming. It's already here. The question is whether you're going to recognize it before everyone else does, or whether you're going to be one of the people looking back in 2 years, wondering how you missed the most obvious setup in the precious metals market. The data is clear, the trend is undeniable, and the clock is ticking.